Hello, everybody. My name is Alesh Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. Part of my monthly routine to get another source of cash flow is to use options, specifically selling put options for cash premiums. I sell them the first week of every month to expire 6 weeks later, the third Friday of the following month. I had the opportunity to present my process, including the live selling of the puts to a group, and I recorded it. The recording is split into two parts. I hope you will find this look over my shoulder informative. Please note that options are risky and should only be used by informed people. Also note that I have the resources available to take possession of the stocks should they be assigned to me, hence the large dollar amounts involved. If you do not have the cash available, you can either buy back the options, which I will explain in the video, sell the stock as soon as it is assigned to you, or use smaller dollar amounts, or just sell fewer options. This is part one. Please see the video links at the end screen of this video for part two. I'll go through the process really quickly, talk about put options. I don't really know the level of experience of anybody, so I'll kind of give the basics so you can follow along, and we'll sort of go from there. I have I think a very simple process of what I do. I do it every month, and like I said, Thursday or Friday, first week of the month. And so a put option is a contract, a very automated one, where the person who sells the contract or writes it is another way of saying it. They will end up having an obligation. So I'm gonna go here to here. So this is the interactive broker screen. You can see at the top here, those are the put options that I've sold previously. Each brokerage will be different, obviously. These are expiring in roughly 2 weeks on December the 16th. We are going to be selling put options for January, expiring basically in 6 weeks, the third Friday of the month. So that's how I do it. You can see the position is showing as negative while regular stocks are showing as a positive and green, while these are showing as negative. This is because I had sold for cash, and you can see the cost basis here, how much I sold them for. I had sold myself an obligation. So they show up here because I have an obligation, which I had already collected money for. And in the previous round, this added up to roughly $2,000. So I try to aim for about 2,000 every month. And so what it does is, so for Whitecap Resources, the position shows as -6, so that's 6 contracts, and each contract is 100 shares, so 600 shares of Whitecap. And what I did is I sold the promise to purchase these 600 shares of Whitecap for $10. Okay, and if the shares go up and they stay above $10, then this will expire on December the 16th, and my obligation is gone, and I will have gotten the $287 right up front. If the shares go down below $10, the person who purchased them is able to sell me their shares for $10, even if at the time they are 9 or 8 or 7 or what have you. So basically I'm selling insurance. We can kind of think of it that way. And uh, so that's one thing. Now the somebody had asked yesterday during the live how the premium or the market value of an option is determined. And it really depends on three things. The primary thing is how far away the strike price, which in our example is $10, how far away that price on the contract is from the current value of the shares. And so that's one. The other thing is how long before the expiry. So the reason I do it on the first Thursday or Friday of the month is because about 6 weeks out is when the time value of the option really starts falling. So the time value is basically how much time is left for Whitecap's price to drop under $10. When it's under $10 in our example, that's called being in the money. If it is above $10, then it is the phrase is out of the money. Okay, so I'll start using that from here on out. If it's under the put's strike price, then it's in the money. If it is above, then it is out of the money. And by the way, if you have any questions throughout this process, please, unmute yourself and just ask me. This is for you. I'm just kind of having you kind of look over my shoulder. And so that's kind of the second thing is how much time is left for the stock to be in the money. That's what the person who bought the put is looking for, is for it to be underneath the strike price. Me, obviously, I'm hoping that it's going to go up. Okay. And then the third thing is how volatile is the stock? Is it moving a lot or little? And that will also play a large part in how much the option is worth. Because if the stock moves a lot, then there's a good chance that within those 6 remaining weeks, it's going to be in the money. Does that sort of make sense? Right? The options are basically an insurance contract where somebody who has the shares is thinking, well, I don't want to sell the shares outright, but I sort of want to protect myself from the shares going down. So they buy the puts, I sell them. They're saying, I think it's going to go down, and I'm saying, I think it's going to go up. So for the next 6 weeks, it's not really an investment, it's a speculation. I wouldn't call it investing because 6 weeks is too short a time frame. So that's the basis of this. Where I'm selling insurance for cash right up front. And so my process is that I sell these puts on stocks that I already have, that I would theoretically be willing to get more of. And so I get some cash right up front, and if the shares do go down, then I'll take possession of the stock. So now you can see here, so for Whitecap, for example, so I sold it about a month ago. I sold it for $287. The promise to buy 600 shares at $10. And Whitecap has gone up. So and of course time has expired as well. So that's the second factor. And so today, the market value of those same 6 contracts is $56. So I'm green over here. In a rising market, it ends up positive. So Enbridge, for example, I sold them for $129. Now they're worth 10. So if I was afraid of Enbridge doing something unforeseen, I could actually pay $10.68 and I could get out of this obligation. So that's kind of the other thing. One, they could expire worthless. Two, I could get the shares. Or three, I could buy back the contract at the current market price. And so, like you can see with some of these, the market is basically thinking there's very little chance of it being in the money in the next 2 weeks. So that's kind of how that works. I can't see anybody, by the way, when I'm sharing the screen, but everybody's sort of okay with the concept there.
Yeah, okay.
So far, so good. Please do interrupt me with any questions, right? If you're not getting it, then let's resolve that. So the only one for December that I'm sort of in trouble with is Northland Power, which the strike price is $39, and I think right now they're about 37 and change, and so that is in the money, and I could get out of it if I paid $597. But I'm just as happy to see what happens in the next 2 weeks and then take possession of the shares. So my overall strategy here is I do this on stocks that I already own, like I mentioned, and if I get the shares, I'm happy, because if I had bought the shares outright and they went down a little bit, like Northland Power did in this case, then I would still keep them. So this way I collected $500 and I get shares that I would have bought. Let's say they were, $40 at the time that I bought them. They were $40 at the time that I sold the put for at 39 strike, and so I would have been okay buying it at $40 and having it go down to 37. This way, I got $500 cash up front, and if I'm forced to buy something that's worth 37 and I'm forced to buy it at 39, it's fine. Just sort of my long-term thinking. Okay. So here's some of the tools that I use. So that's kind of the high level strategy. Let me actually touch before I go on. Let me touch on a couple of the downsides. So one is if the share price goes up, the put expires worthless. Nothing bad happens. I would have gotten the cash up front, so no problem. But I don't get the shares, and I miss out on any upside. So if I had bought the shares outright and they went up, I would have benefited. By selling the put, I got cash, but I'm not benefiting in the shares going up. So that's one. And if I really love the shares, then I'm not going to get them. So I make myself feel better that I'm doing this on shares that I already own. And so if they go up, I am benefiting because of stuff that I'm already holding. The other downside I've sort of touched on already. If the shares go down, I am paying more than the market price. Like I said, if I had bought the stock outright and it went down, I would have held on to it. So I would have been in the exact same position. So I don't really mind it from that perspective either. So for me, this is a way to, number one, collect some extra cash, and number two, get cheap shares. And so this is playing into my long-term investor philosophy that I am buying cheap shares. Okay, so that's the strategy. Very simple, definitely some downsides. Let me show you here. So I do have a tracking spreadsheet. And so going back to middle of 2020, so first column is when I sold it, here's the expiry date, okay? And here is how much I'm at risk for. So with Whitecap, what I was doing is I was on the hook for 600 shares at $10. So $6,000 is my exposure. So that goes into here. Here's the premiums that I've collected. Okay. But looking at column K, when you annualize it, this is the return. So basically, in 6 weeks, when you annualize, so for example, this one, $255 was the premium I collected. For 6 weeks, I'm on the hook for $4,500. When you annualize that, that is worth that is 45% return annual. So that to me is quite nice. And keep in mind, I don't actually have to take possession of the shares. All I have to do is pay this price, the market value, and I can get out of it and I can buy it back. So you're getting some very hefty returns. The ones that have super hefty returns is usually because they're very volatile. And then you can see that I end up taking A means assigned, meaning I ended up getting the shares. As you're looking through 2020, as the market was going up, I got a lot of expiring worthless. So that was good. And then just to show you kind of the bad side of it, back in June, 4 months ago, because of the downturn in the market and the bottom, I pretty much ended up taking possession on everything, with the exception of one down here that expired worthless. So that is what can happen. But then the stuff that was expiring in November, it all expired worthless. So to me, I just keep doing this methodically, month after month. And I know with a rising market that as long as I keep selling the puts underneath the market as it's going up, over the long run, they're gonna expire worthless more often than not. So far, where's my record? So far, my record is 68% is the percentage that I'm expiring worthless. It used to be 3/4. It used to be 75%. But it was affected by what happened in June, kind of this year. But my thing is that in an upward trending market, it's going to be positive. Over those 2.5 years, I collected 44 grand in premiums, and I cash flowed 15,000. So I basically give myself a negative if I sold a put and I ended up getting the stock, and I got the stock for less than it was worth, I put that as a negative for myself. Like I said, it's sort of a paper loss, but in order to know whether this is effective or not, I sort of need to track it. Now, let me find one here. Okay. What happens is sometimes you can get the stock and you still end up being positive because of the premium that you receive. So here's one. So this was so EFN Enter Plus, I believe. I promised to buy it for $7,000, and it was just in a money, but by like a couple of pennies. So I ended up buying it for 6,950. Q Trade, of course, charged me $55, but because up front I had collected $236, I still ended up being positive on it. So that occasionally happens, that you get with the cash you collect up front, you get a buffer. Okay. Occasionally. Oh, here's another one. So I promised 10,200. I got it when it was worth 10,080, and so I ended up still getting $76 positive. So anyways, so I do that. So any questions? Does that all sort of make sense, or any puzzle looks out there? Okay. So what I do is there's a website and an organization out there called Options Play, and they deal with options trading. They sell courses and they sell subscriptions to a very nice tool. Now, 2.5 years ago, I happened to get in on the free Canadian version. You have to pay for US version. So I only have access to Canadian stocks, which is actually all that I ever wanted to do anyway. So this worked out perfectly for me. I don't know whether you can still get a free version for Canadians. Mine seems to be grandfathered, and so I'm very excited to keep using it. So I'll show you that in a sec. But one of the things they put out, and I'm going to refresh this. Oh, maybe it refreshed. Okay. So what they do is just they calculate automatically and populate the spreadsheet. And so Options Play Optimal put report. Okay. And so they give you an annualized return if you use these. And basically what they calculate is they give you a strike price, they give you an expiry. So it looks like we're going to be doing January 20th. For the most part, and I use this sort of as a guideline, and I'll show you what I do. So they give you the strike price that is going to sort of maximize your return. You can see the implied volatility. When I said volatility was one of the things that determines the premium that you can get. You'll notice sort of this volatility inching down, as well as the annualized return, right? Like the ones at the beginning are just ridiculous. Like I wouldn't touch them. I think they're probably wheat stocks anyways. But so what I do is I created myself a little spreadsheet, and I copy this into my spreadsheet. So on the left is my stocks. Here is the ones they're recommending, and then I just have a formula that says look in column A for the value in column C, and if it exists, tell me. And so the first one is NFI, New Flyer. They're making buses, and so I do own them, obviously. I'm going to pass on that one. So if we go over here, and I'm just going to search for NFI. So that one would be getting me a 41% annualized if I sold a put option with a strike price of 975. I know that NFI is still going to have some issues. I could also, this is another site that I use, Stock Chase. I'm sure I mentioned it multiple times. So here's transcript of what experts are saying. It's one that I sort of want to wait on. I don't want to sell my existing shares because I don't know when it's going to recover. But yeah. So I'm going to leave that one for now. I think it has till the end of maybe 6 months that I would want to take a look at that one. So going back to my spreadsheet, next one is Whitecap Resources. So as I had been talking about, I have a put on it already that's going to expire in 2 weeks. So the question that I'm going to say, well, this one looks pretty safe that I'm not going to get it. So I'm going to think about doing it um, for the January expiry. So I'm going to look here. And by the way, this put report you can get for free. It's just a link on their website. So they're suggesting 10.5. So I'm like, yeah, okay, let's see what happens. So now I'm gonna do a little research here. So I'm gonna go WCP. And you can get this information elsewhere, including Yahoo Finance. So I'm going to show you that in a sec. So they have what they think is 1 month and 6 months. So they're showing green down here. So they're bullish in 1 month and 6 months. So that's positive. Now we've sort of transitioned from investing to speculating here, because as I said, 6 weeks isn't really a long enough period for us to be looking at balance sheets and income statements. So this is where a little technical analysis can come in handy. Okay. So I'm like, well, you could say it had bounced around 1050 a little bit. So you could say there's a support line right about there. They're looking positive. And relative strength compared to the index are giving it a 4 out of 10. So that's a little bit of a negative. So let's look at them in, what's it again? WCP. So make sure you get the Canadian one. And I'm going to look at the chart. And so I use a couple of technical indicators. One is RSI and the other one is MACD. So RSI, the range is 30 to 70. If it's over 70, then it is overbought. If it's under 30, then it's oversold. So it's at 54. So sort of middle of the road. So that's a neutral. And for the MACD, the purple line is under the orange line. The purple line is, I believe, a 9-day moving average, while the purple line, I think, is the 26. I'd have to check. But if the purple line had just crossed over the orange line, I would have felt better about it. The purple line's still underneath it. Obviously, I feel fairly good about oil in general. So Whitecap isn't the bad one for me. I'm just gonna check it here. So this is now Qtrade, but this is sort of where I'm used to working. So we look at Whitecap. A whole bunch of buys. It's paying a 4% dividend yield, tiny percentage of their profits. So even if I get the stock, I would still feel pretty good about holding it. So that's another plus. The other thing that I like to do in here is I go to historical data, and there's a specific format that this comes out in. And what I do is I import it into Excel. So I do max. I'm going to get 20 years worth of data. I'm going to switch it to monthly, apply. I'm going to download it. And then what I did is I had written a macro that will take, uh-oh, downloads. That will take what Yahoo spat out, and I'm going to No, that's not what I wanted. That's not what I wanted at all. Macros. Create. Now I'm going to copy and paste it, and I'm going to run it. And I can send this to everybody who's interested. And then what it does is it formats raw data into something informational. So what I can glean from this is what has historically happened in the 2 months that I'm interested in. So I'm interested in December, more positives than negatives, but not really a good trend. And in January, it's the other way, 9 positives and 11 negatives for the month. Okay. So sort of neutral there for me. So I've had sort of a couple of positive indicators and several neutral ones. So I'm not really feeling awesome about it so far. So let's go back. Let's go back to here. So what I'm gonna do is I'm gonna go WC. Oh, actually, one other thing in here. So in here, they actually help you out. On the right-hand pane, you can flip this to income, and I'm gonna say no, I don't own any shares. So it's going to and this they changed the interface recently. It's way more confusing than it needs to be. So instead of 10.5, 10.5, there's here on here, they're suggesting 9.5. And so when I look at it, it tells you that it's going to generate money. And based on historical volatility, it has 77% chance of expiring worthless. That would be too easy. So what I do is I'm going to go and modify it. The expiry is still January 20th, like we said, but I'm going to modify this to be closer to the current price. The current price is $10.90. They had it significantly below. In order to get a higher premium, I'm going to get it closer because then it has a better chance. So that's 77 turned to 55, right? I don't mind getting the stock, and I'm going to get a higher premium. So you can get a sort of a final thing here. There's no earnings dates between now and the expiry. It's predicting 33% annualized return, but it's telling me, and I know it's covered, but it's telling me that it has only a 55% chance of expiring worthless. Depending on how much you like the stock, you can fiddle with the strike price, and you can have it at $9 if you want. Now, can I get back there now? Okay. Whoop. Okay, apparently everything reset. So if you don't feel comfortable with 77% expiring with the strike price being at 9.5, you can modify it, and you can say, you know, I don't really like the stock, so I'm gonna go for $9. Well, now it's 86% chance of expiring worthless, but the premium went down. So this is the price of the option is determined how far away you are from, or one of the factors, how far away you are from the current share price. Okay. So I do feel pretty good about this. I don't have a huge position yet. So what I'm going to do is I'm going to go Whitecap Resources. I'm going to go options chain. Now here, and each brokerage will be different. So same idea, but you'll have to get used to the interface. So the one I'm going to choose is January 20th, 2023. So in 50 days. So I'm going to go here. You see green is in the money. The white is out of the money. We're looking at puts. Ignore the left-hand side. That's the calls. And we said $10.50. So just out of the money, right? They're at $10.91 right now. So what I do is, and here's how you do the calculations for the annual return. So for $10.50 strike price, you have the same bid and ask as you do with regular stocks. This is pretty good. Sometimes they're very far apart. You're going to see that in one of the other ones. But let's say I can get 51 cents. Okay. So 51 cents, the amount that is at risk is $10.50. So just the raw return is 4.8%. It's also how much the stock can go down for me to still make some money because of the premium that I'm collecting. So now I annualize it. So I multiply it by 365 and I divide it by 50 because that's the number of days. And so that means that if I do get 50 cents for it, I will be getting a 35% annualized return on that. Okay. So I'm going to go ahead and do that. So sell, and I'm going to increase it to 6. So I would be on the hook for 6,300. January 20th put with the strike price of $10.50. I'm gonna go here and okay, well, so I'm gonna go back to 6 here. So you do use a limit order. I could probably do a market, meaning that I would just get 49 cents because that's what the bid is. I'd like to see if I can get a little bit more. So I'm going to try 50 cents. It's likely this is going to get executed right away. And I make sure that it's on sell. Sometimes Interactive Brokers is a little funky and sometimes it switches it to buy. So I have to make sure that it's a sell. I'm going to do a preview. So I'm going to collect $292.50. Commissions is $7.50. So I'm going to transmit it. Let's see. And it's been filled. And you can see it's sort of moving up as well. So I sort of got lucky on that. No, other way, actually. No, I could have tried 52 cents or 51 cents. So I got it for 51. No, 50. I'm sorry. But anyways, I got the cash. So I sold 6 contracts, which is 600 shares. So I'm on the hook for $6,300. So we're gonna click done and move on to the next one. Any questions? So that's a complete cycle there. And we'll go to orders and trades.
Hi, Alice. This is Gord. I've got a question for you.
Of course.
So you did the match of the stocks that they're recommending against the stocks that you own. Why would you pick one that you own when you could just pick any stock?
Yeah, good question. One is I already have 60 stocks, frankly, and I'm very careful about adding more, and I want to prune my portfolio, if anything, because it's a little hard to keep on top of.
Okay.
So that's one, not the primary. The primary would probably be that I obviously like the stock at today's price, or I would be selling the ones that I have. Right? That's sort of the theory behind it.
Okay.
because at whatever price it is, if you don't like it at that price, you should be selling it. Uh, and so, because I do like it at today's price, then I am holding it, and I should be willing to buy more at a lower price, which I got. Right at the time that I sold it, the stock price was $10.91, and I will now be getting it for $10.50. So I got 41 cents off a share. Plus I got $300. So that's kind of the theory behind it. You're right. I could and at the beginning I did do this, right? Like you see Ethereum and a bunch of weed stocks, and they have a huge amount of volatility because they're not profitable. Um, and so like, yeah, I'm sure this is a wheat stock of some kind. Um, oh, natural gas and leveraged. Okay, I'm sorry. It's natural gas. So it's a commodity, right? So
Yeah.
I could go for stuff like that and get super high um, returns, but in the end, I'll probably end up getting the stock. Now, if I was bullish on yeah, they're both natural gas leveraged. I guess U is for up and D is for down. If I were super bullish on it, then I mean, I might have gone for it. By the way, a couple of examples, and I'm going off on a tangent. But the third thing to answer your question, the third thing would be is I use it on stocks that I already own because I also know them and I'm familiar with them and I sort of know what to expect. Uh, so that's another reason. But
Yeah.
I did this for Algonquin when they had their bad report a couple of weeks ago. I saw it on the phone at the gym and I'm like, okay, when I come home from the gym, I'm just gonna buy some. And then I said, well, if you're willing to buy it today at whatever price it is, why not just sell a put on it? You'll get extra cash, you'll get it cheaper than today's price. If you were willing to buy it anyways at whatever price it was, wouldn't you be even happier if you got it at a cheaper price than it is right now? And so that's kind of the way I think of it. So I sort of went off on a tangent. But anyways, I hope I answered your question.
Yeah, it does. So I guess the underlying principle is it has to be a stock that you're comfortable owning. And in your case, you don't want to expand your portfolio, so it makes sense to just increase those holdings if you have to.
Yeah, and comfortable getting more of it,
Yeah.
right? So Algonquin has come up, of course. Let's see what. So Algonquin, they're recommending $10. It's like $10 and change now, if memory serves. It has had a big drop. I'm okay selling kind of small puts on it. If they do cut a dividend, I'm gonna buy a whole bunch just outright. So they're at $10.22. Now you're getting reds here, so that's already not not great. And if I say I wanted for income, so they're recommending further down. They're recommending 9.25 here, while the spreadsheet is saying 10. It looks like they're sort of flattening. I might get $5,000 worth, as I was showing you guys. I might be getting 10,000, sorry, 5,000 and change, 5,250. I might be getting those already. So I think I'm okay with Algonquin. I'll see what we can get here. AQN, Algonquin and utilities. Now, okay, they're bouncing around a little bit. So I'm gonna do options chain. I'm gonna select the one that's 50 days out. So there's a little bit of a spread. I'm also gonna try for 50 cents on this one. Let's just do the math real quick. So 50 cents divided by 10, as far as how much money's on the line, annualize it, is going to give me a 36% return on the money at risk. Now, keep in mind, by the way, if I'm right and these expire worthless in the next 6 weeks, I theoretically made an infinite percentage return because I made money out of nothing, right? I didn't have to deposit anything because this is a margin account, so the puts are covered by my other assets. So I didn't have to do anything. So if I was right and Algonquin goes up, then I made the money off of nothing. So that's sort of a nice way of looking at it. Okay, so I'm gonna go order. It is a sell. So right now the bid is 46 and the ask is 50. So because the previous one executed really quickly for me, I'm gonna go 50 cents. I'm gonna go on the high end of the range. Okay. We're doing the strike price is 10. I'm just gonna do 5 contracts, which means 500 shares, which means I'm gonna be on the hook for 5 grand. Okay. So I'm gonna go 50 and I'm gonna submit the sell order. I'm assuming it's not gonna execute. It's just, okay, so this one's just been submitted. And so what we'll do is if I go to my trades here, then this was the one that we had sold earlier. That one was filled. And then ignore this one. I canceled it. That was just my practice from this morning. So I'm selling the Algonquin one, and it's just been submitted, right? So what I'll do is I'll do a couple of others and then I'll come back here. And what I'll do is I'll take a look. I'll do modify and I'll see how these are moving. So if the share prices are going up, then these will start coming down because it's going to be further out of the money. And so I'll have to move my price and I might have to go 48 cents, 47 cents or whatever. But if the share price is going down, then eventually these will move and eventually somebody will take me up on this offer. Everybody sort of clear on that one? During the day, the share price moves, and so does the option price, according to what the share price is doing. So I actually like selling puts in a slightly downtrending day because that way I can just set this stuff up and leave it, and by the end of the day, it'll all get filled. But if the market is going up, then I may not actually get any. I may not actually sell anything. I may not sell any options without making adjustments. So I'm not seeing this moving. So we're going to leave this for a little bit. I mean, I could flip it down to 49 and submit it. I'm just going to close this and leave it. Give it a couple of minutes. Let it breathe. It looks like the TSX is up slightly today, but of course what matters is how it moves after I've put the sell order out there. So we're going to keep going. So that was Algonquin. So next, Canadian Natural Resources. Again, super familiar with it, right? We know what we're getting. I'm going to type it in here just for kicks. And And what were they suggesting? CNQ. So $80. $80. So CNQ is $80.90. So they're all super close to the money, right? Here the tool is a little bit safer than the spreadsheet, and so they're suggesting further down. I'm gonna modify it. So with what they were suggesting, you get a good margin of safety, and based on history, at 88 and a half, it would have 80% chance of expiring worthless, which is generally what people like me are looking for. If you don't mind getting the stock, you can go. What was it? $80. Okay. It has. Why were they suggesting? Yeah. Okay. Sorry, I forgot to flip the switch here. So yeah, that's why that was weird. So they're suggesting way out of the money at 72. I'm gonna have to modify that. It resets the switch. If I say no, then that means I'm selling the put. If I say yes to owning the shares, then that means I'm gonna be buying the no, other way around. Anyways, so 50 days out, and I'm gonna move that to 80. Okay, so now it has a 50% chance basically of expiring worthless. Not great, but again, I don't mind getting the stock, so that's my way of thinking about it. So everything is good except the high chance of me getting the stock, which I don't mind. Let's take a look at it just for fun here. CNQ. Make sure to take the Canadian one. And historical. So that one was heading down. So this one I would be comfortable just putting something out there and leaving it. But let's check the historical data again. Set that to max, set that to monthly, apply, download, open. Said open. Okay, thank you. And I'm gonna do my little macro thing again. And create. Boom, run. Go to this and oh, too far. So December is good, 17 to 10 being positive that month. So there is an actual good correlation. And January is looking positive as well, 16 to 11. So that's a positive. Let's go back to charts. So that one, RSI is 53, so it's sort of midway, and the MACD isn't really that helpful. Okay, so let's try to sell something on CNQ. I do already have a put out there for CNQ for 78.50. Okay. But if memory serves, go back to the portfolio. That one actually has a chance of being, because the strike price on that one is 78.5, and currently we're at, let's say, 81, and so that one still has a chance. So this value is relatively high as opposed to Emera and Manulife, which the market is thinking has no chance in 2 weeks. But so there's some chance that I could get more CNQ from this one. So I'm going to be a little careful. CNQ. Options chain. No. 50 days out. We said 80. See, now this one has a bigger spread between. So like I'm going to start out at, let's say, $3.60. And I'm going to leave that because it seems to be trending downwards, the share prices. And so I'll feel comfortable leaving that. So I'm going to do sell here. That's okay. Not sure what's happening now. Okay, CNQ. So we're gonna check. So we're gonna get, let's say, $3.60. So $3.60 divided by the $80 share price. So 4.5, annualize it. So still $32, so not bad. So here, let's think about the quantity. I'm already going to be getting some, or possibly getting some, I'm sorry. 7,800 worth. I do like CNQ, but for $80, I'm gonna do what? 4, 5 is. No, I'm sorry. $80 will be. So I'll do 1. Because it's 100 shares. 80 times 100 is 8,000. So the minimum that I can do is 1, obviously. So this is going to be. I'm actually going to put in a little bit more. You can see the share prices are going down. So I'll do 370 and then just let that one sit there. I'm going to be on the hook for $8,000 here. The minimum you can do 1 is 1, and so yeah, CNQ is always a little bit tricky. So I'm gonna submit it. Oh, okay. I could have gotten more. It got filled right away. So looking back at our trades here, 2 of them got filled already. Can I get rid of you? So far I made $670. And that Algonquin one is still sitting. Let's check in on it. I had it at 50 cents. So it's sort of on the high side. So let's bring it down 1. Modify. Nope, nothing. It updated here, 49 cents, but still no takers. So here's the thing, as the stock is going up, because that's what's happening, that's why these numbers are getting lower, because as the stock is going up, it's further out of the money. So now I have a choice. Should I put it down to, 47 and get a sure thing? Or should I just leave it? So that just depends on how much I want more Algonquin. So I'm gonna bring it down a little bit more. So you sort of ease into it when you have a big spread between the bid and the ask. You can sort of sneak up on it, but it's also moving on you, which is the unfortunate thing. So I'm gonna bring it down one more. Any takers? Sometimes it's a couple of Mississippis. No? Okay. Fine, be that way. Moving along swiftly. So that was CNQ. Suncor, I'm still good with. So that'll be another one. Any questions as I'm sort of blazing through this? This is all making sense. Oh, I missed it. 43. 43 is a winner. Uh, so Suncor's looking like it's got a bit of a downturn, so I'm gonna have that as a negative. Let's check it out here. It is also heading downwards, so I might be able to get some. Now that one's approaching oversold here, right? 30 on the RSI means oversold. And so 36, so I feel more comfortable with that. Now what was their 42? So they're saying 42. It looks like there were a couple of things. There's looked like it bounced here. That used to be resistance. So this is giving me this little valley and then bounce back up is giving me a bit of a comfort that maybe 42 is where it'll bounce. So 42 I might feel comfortable with. So let's see what we can do with Suncor. Okay, each time it's different. The interface interactive brokers I've had for about 6 months and it still eludes me, unfortunately. So 42. Okay. So let's say I would do 145 divided by 42. So that'd give me a 25% return. Let's have a quick glance at Suncor before we go on. Yeah, it's very similar to CNQ. Okay. It's definitely from a technical point of view, it's taken a bit of a downturn. I'm gonna run my historical data thing again on Suncor. See if that will give me any clarity whether I want to do more or not. So December looks very positive historically, and then we have a slight negative trend for January. So that makes me feel a little bit better, at least historically. Obviously, winter season. So yeah, I'm on board with Suncor 50 days out. Let's say I do 225 divided by, no, where am I? 42, right? 42. Um, so 42 will be, let's say, $1.45 divided by 42 times 365 divided by 50. So you can see it's gone down from 30% annualized into the 20s. I usually stop when I either reach about 50 or 60 grand on the hook or 2 grand. But like, I don't want to get into single digits or anything like that. So I have in the past. I don't think there's a point to it. So I'll stop like in the teens as well. So yeah, let's do 42. Sell Suncor. Sell order. I already have some. I'm gonna do, because it's $42. I'm gonna do 2 of them. So that'll put me on the hook for 8,400. And this one's also going down. Remember, I tried. What did I do on here? I did 145, and that's already under. So you can see these things moving. So I can easily do $1.50. So I'm gonna get more than I thought in my calculation here, because here I thought $1.45. But it just shows you how you can see the stock moving, and how that affects the premium you can get for the option as well. So I'm gonna do $1.50 again. And got it right away. So I could have waited.
Alex, can I ask a quick question?
Of course.
It's Derek here, and thanks for doing this. This is great. Just back to when you were buying there, you had selected quantity of 2, and you said that puts you on the hook for how many shares, and how does that work? Like, that you're
Yeah.
choosing-
Yeah. And by the way, everybody, don't hesitate to ask questions. This is for you. Like, I'm hoping this is kind of showing you what I'm doing. So I'm close to $1,000 in cash right now from the 3 that I've sold. What I'm on the hook for is, so quantity. This is contracts. Contracts and shares. A contract is 100 shares. It's confusing for about 30 seconds. There's no way you should mix the two up, because if you put in, I want 200 shares instead of like, if you put 200 contracts instead of 2 contracts, it's going to show you like these gigantic numbers, and you're like, okay, I've got that wrong. But so on the hook, so 2 contracts means 200 shares. 200 shares times 42 is $8,400.
Okay, thanks.
Okay.
Is it always 100?
The contract is always 100 shares.
Okay.
That's
Thanks.
the minimum you can do. With high priced stocks, that becomes difficult, because you'll notice CNQ. I only did 1 contract, because that's 100 shares. 100 times 80, which I'm on the hook for, is $8,000. I typically, going back to my tracking spreadsheet, if you look at this column, the biggest number I think is that I've ever done. So there's a 10,000 Bank of Nova Scotia, 13 grand, 12 grand. Like, I don't, 14 grand. Okay. So I usually kind of aim for between 5 and 10. Sometimes I feel strongly about it, like Royal Bank, right? Like, I'm not gonna be afraid something terrifying is going to happen with it. I did end up getting it. But I certainly don't mind. So you know, depending on the size of your portfolio and your comfort level, you know, let me see if I can find a small one. I think I've done like 4 grand here and there. Oh no, 2400 right there. This is Ballard Power, right? They make forklifts, really. What is it? Hydrogen cell, I think. So I wasn't feeling that awesome about them. Fortunately, it expired worthless, and I got a nice percentage payout. So it goes on how you feel about the stock, how much of the stock I already have, you know, what is still sort of up in the air as well, right? Because these are going to expire on the 16th of December, so in 2 weeks I'll see how much of this is actually going to happen. In those 2 weeks, the market could crater, and I could get a whole bunch of them. So you never know. So yeah, so that's sort of how I think about it. And you know, in my little thing here, I enjoy Excel very much. I don't know if you guys are able to tell. I have formulas where I'm like exposure for the next option's expiry date. So for the ones that are expiring December 16th, my exposure is 69 grand. So far, the good work that I've been doing today, where are we? So far, I'm on the hook for doing some quick math. 16 plus another 6. So far about 22, 23 grand. So I'm definitely going to keep going. As I've been talking, Algonquin's, yeah, see, so Algonquin is going up in price, and so uh these numbers have moved. So I'm going to try, you know, ease into it. There's no problem checking back here every so often and like, hey, what's happening? Um, so I'm gonna submit it. There's always no, okay. I always wait, you know, with bated breath. Is like, is it gonna hit? Is it gonna hit? It didn't. It did not. Okay, next one. So I sort of go. So this is gonna be it for, you know, I'm gonna do this for another 45 minutes, give or take. This is what I do. I sort of go down the list, right? I start with the highest volatility ones because that's the way this spreadsheet was ordered. And that's how I copied and pasted it into my spreadsheet. So I just sort of go down the list and I sort of make the call of, you know, do I want to do this or not? So this is Whitecap. Let's check in on Whitecap. I do have a. Oh, sorry, not White. I didn't have a good sleep, and I'm trying to do too many things. WTE. West Shore Terminals. Okay, so that's not Whitecap. That's looking tragic. So Whitecap is a coal and potash terminal, actually very close here in Vancouver. They've had. This is a good one just to analyze the stock more than just the options themselves. So it pays a nice dividend. It's a utility basically. Uh, there's a there's always a chance that some private equity company is going to take them out. Uh, their market cap is 1.5 billion, so they're smallish. Uh, Nobody's terribly excited about them, but with this yield, what? Um, WTE. I do have quite a bit of this already, so 23 and a half. So yeah, again, very close. It looks like they've sort of been bouncing around the bottom here for a while. So I'm thinking this is creating a support level. Let's zoom in a little bit. Yeah, so it looks like in the high 23s, looks like there's support there. And with this sort of a yield, let's just check the cash flow while we're here. I just don't want them to cut the dividend, right? My reason for living. So $1.20, their cash flow is a $1.89. Not terribly comfortable, but they are able to cover the dividend. I usually prefer 3-1, and I mean this is 1.5 to 1. So I'll do a little bit. How is it moving today while we're here? Okay, so that's not great. It would have been better to sell the put earlier. Now, if it keeps going up, I'm never gonna sell it. This is also a good one to Toronto, yeah. Let's check the chart. So 45, so it's sort of on the lower side. Purple is above the pink or peach, whatever it is. Okay. Historical. Let's check on that. So as you can see, I'm sort of combining long-term investing with technical analysis and a little bit of speculation, if you will. Okay, so December isn't great. That's negative. But positive in January. More positives than negatives. Okay. So WTE. Store terminals. And 50 days out. You'll notice, depending on the size of the stock, you may have more expiry dates to choose from. This one is the third Friday of the month, and that's it. Some of the others had like weekly expiries and so on. So somebody had asked previously whether it's easier to do US options rather than Canadian. Canadian tend to be less liquid. Now, what was it again? 23.5. So like you can see a 20-cent spread. So I'm going to go in like at 85 cents. But this means it's not very liquid. While if I chose a bigger company or if I did US, these would be much smaller spreads. You know, it would be just a couple of pennies apart. And so that means you can always get in and get out. While I'm going to put in 85 cents and there's absolutely no guarantee of anything. I mean, I could put in 70 cents and be sure of getting it, but or getting it sold. So I'm going to go here. It is a sell. I'm going to put in, and this may be only in multiples of 5 as well. I may not be able to put in 83 cents. Let's see. Yeah, see, it jumps all the way down to 80. So I'll put 85, see what happens. Especially since it looked like it was recovering, I'll probably have to bring that back down. So it's 23 bucks and change. So I'm gonna do what, 3 contracts to get about 6,900, give or take, as far as risk. And quick math. divided by 23.5 times 360, whoop, divided by 50. Okay, I screwed something up. Fat fingered it. 85 divided by the money at risk, which is 23.5 times 365 divided by 50. So still 26%. Sometimes I'll go, by the way, and I'll go in here and I'll go find WTE, and it's like 12%. Okay, that's so better than I got previously. 25%. So we're in the neighborhood, but that's when it was very volatile, I guess, and I ended up getting the stock. 24, same thing. Got a better return, but ended up getting the stock, which is, like I said, generally not what you want. Here, I'm gonna say I got lucky because I got a 34% annualized return, and it happened to expire worthless. So I will go and just historically see how I've done. But anyways, this hasn't moved, so I'm gonna submit it. I'm gonna wait. All right. Fine. So now it's showing me that I've got 2 outstanding ones. I feel good about the ones down here. Obviously all oil stocks, so it is what it is. Let's check in on Algonquin since we're here. I usually don't check in that frequently, but okay, let's bring it down. Damn you. Okay. Yeah, if they're heading up, then I'm never gonna get it. I'm never gonna sell it, I mean. Okay, next stock. This concludes part 1 of the Put Selling Live video. Part 2 is available in the end screen. I hope you found the session useful. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.